In this video, we will be discussing about capital budgeting and traditional methods used for capital budgeting. Hey folks, welcome to our channel. On our channel, we strive towards conceptual learning because when why is clear, how becomes easy. So what is capital budgeting? It is basically process of making investment decisions in capital expenditure. And now what is capital expenditure? Well, capital expenditure is money spent by a firm on fixed assets. So we can say capital budgeting is making investment decisions about expenditure, the benefits of which are expected to be received over a period of time. Can you think about any such decisions? Yes, it can be about purchasing a new building or a new machinery or whether to purchase a land or not. But why is it so important to give so much emphasis on such decisions? Well, such investment decisions are non-flexible long-term commitment of funds. This is because capital expenditure are generally irreversible. You cannot sell a building or land instantly. It is difficult to find instant buyers, and even if you do find, you won't be getting fair price. Nextly, capital expenditures affect profitability of firm in long run, and profit maximization is sole purpose of firm's existence. Capital expenditures are of national importance as they affect GDP, employment and growth in the society. Moving to the practical part, we have some methods of capital budgeting. Broadly divided into two parts. First are the traditional methods and second classification is time-adjusted methods. In this video, we would be covering only the traditional methods. Time-adjusted methods would be covered in next video. You can pause the video and take screenshot of classification for theory purpose. Our first method is payback period method. In simple words, this method will tell you the period in which the asset returns itself back. Then all investment proposals are ranked according to their payback periods. As we want to cover the cost of our investments as soon as possible, investments with shorter periods are preferred. We use the following formula to find out payback period of an investment. That is, cost of an asset or cost outlay of a project divided by annual cash inflows. Annual cash inflows is the amount of cash coming in or going out. One thing to remember is that here we take only cash inflows or outflows. So depreciation is added back to net profit. Let us understand it in a better way through an example. Here cost of project is 5 lakhs and annual profits is of 80,000 after depreciation but before tax. And rate of depreciation is also given to us, that is 12% per annum. Moving towards the solution. Profit before tax is 80,000. Now we want after tax profit, so we subtract taxes assuming it to be 50%. Now this is actually profit after tax and depreciation. So we add back depreciation. 5 lakh at the rate 12%, we find the depreciation to be 60,000. So 60,000 is added back. Solving this, we get our annual cash inflow of 1 lakh. Let's put these values in formula. So here, cost of asset is 5 lakh and annual cash inflow is 1 lakh. It gives us payback period of 5 years. It means it will take me 5 years with 1 lakh of annual cash inflow to cover cost of asset, which is 5 lakh. Pretty simple maths, right? Let's take a quick look at advantages and disadvantages of payback period method. This is simple and easy method. It also saves cost as decision making is quick and requires less efforts. Loss through obsolescence is also reduced as project with shorter payback period is preferred. This method is of great importance to firms with poor liquidity position. On the other side, this method ignores cash inflows earned after payback period. Even after paying back, the project may provide you some more return. That is the main reason to make an investment, to earn more return than you invested. Nextly, minimum acceptable payback period can be different for large firms and small firms. A larger firm may look for more returns even if payback period is bit more, so it is subjective. It ignores time value of money and treats all cash inflows equal, but it is not so. Sooner you receive money, better it is. Two machines having same payback period, a machine that returns more of its cost in early year is preferred. Due to all these disadvantages, next method was developed, that is improvements in traditional approach to payback period method. In simple words, these are just improvements in payback period method. So there are 4 of these. First is post-payback profitability method. Here, improvement is that this method takes post-payback returns also. So firms can compare both payback and post-payback returns of various investment alternatives. Second we have is payback reciprocal method. It is implemented to estimate internal rate of return of a project. This method is not so much appreciated and is not preferred. The third method is post-payback period method. This method suggests to select alternative with greatest payback period, which means longer post-payback periods are preferred. It is also known as surplus life over payback period method. The difference between first and third method is that in post-payback profitability method, emphasis on returns is there, but this method focuses on the duration of period for which post-payback returns are received. At last, we have the discounted payback method. Here, in this method, outflows and inflows are discounted to present value, and where total of outflow is equal to total of inflows, that period is the discounted payback period. Next method is rate of return method. It takes expected earnings from investment over their whole life and uses concept of profits rather than cash flows. Project with higher rate of return is selected. This is the last method under traditional methods but has 4 parts. Let's discuss each one of them quickly. The average rate of return method takes average annual profits and divide it with total or net investments in the project. This is then multiplied into 100 to obtain a percentage. This percentage tells you the average return you will get on your investments. Next is return per unit of investment method. Here, in place of average annual profits, we take total profits after depreciation and taxes and not the average one. Third method is return on average investment method. It is similar to previous method, but here in place of net investments we take average investments. These methods look similar but are very different. Good part is that the name of the method will tell you what it is supposed to tell, and you can write formula using its name. For example, in return per unit method, we divide total profits with net investments, but in return on average investment, we have the same return, that is total profits, but will divide here with average investments. The last method is average return on average investment method, sometimes also called as ARR method. In this method, average annual profits are divided by average investments in project. And this is the most appropriate method of all the 4 methods of rate of return. Now here's the tip. You don't have to learn all 4 rate of return methods. When people say rate of return method, they are usually talking about ARR method. Let's check out another practical and put ARR to work. There are two machines E and F costing 60,000 each and having expected life of 5 years. The profits are given in the table below. Let's add them up all. So we have total profits of 85,000 from machine E and 90,000 from machine F. These are profits before tax. So let's make it eat. Earnings after tax. So let's tax, assuming it to be 50%, we have profits after tax and depreciation. 42,500 for machine E and 45,000 for machine F. But wait, we require average profits after tax and depreciation. So we must divide the total profits by number of years. Now we have average profits of 8,500 and 9,000 for machine E and F respectively. Also, we need average investments in project for formula. Since cost of both machines is 60,000, we get average investment of 30,000 for each machine. Putting values into the formulas. So for machine E, average profits are 8,500 and average investment is 30,000. For machine F, average profits are 9,000 and average investment is same, that is 30,000. Solving it, we get 28.33 rate of return from machine E and 30% from machine F. Which one is more? Yeah, the 30%. So investment will be made in machine F. This method is also easy to understand and calculate. It takes into account all earnings, payback earnings, post-payback earnings, all of them. This method is dependent on profits, so it is supported by financial data. Disadvantages of this method is that it ignores cash inflows, which are important to maintain liquidity. It also ignores the payback period. Return of 20% is better than 19%. But what if we earn 20% return in 2 years and 19% in just 1 year? So it's not always telling you the correct answer for where to invest. This method also ignores the time value of money. Also, rate of return method is not applicable where investments are made in parts over a period of time. So with this, we have ended our first part of capital budgeting. Please like the video if it was helpful for you. Subscribe to our channel and hit the bell icon to stay connected. Let us know your experience in comment section below. Meet you soon in next video.